Good morning, good afternoon, good evening, one and all. Time for another fun-filled, exciting adventure of the Smoking Barrel. I'm Rustin Edwards, based in Geneva, with my fresh back from vacation co-host, Mr. Matt Stanley. Man, you are looking tan,
Oh, mate.
relaxed.
Oh, mate, don't. Thank you so much. No, I do feel relaxed actually. Do you know what? It's funny because when people usually come back from, I'm not being smug here, but I am. Don't care. When you usually come back from holiday, it's like, oh God, I've got to go back, and you get on the plane. It's like, have you got your coats ready because it's going to be freezing cold when you get off the. No, not here, pal. Not here, brother. That was really bad. Because it's like 32, 33. The weather's really great. I'm playing golf for the first time on Sunday for ages. But what the frick has happened in oil markets? I have turned my back for 1 week, and what do you reprobates do? You sell off by $5 a barrel. What's wrong with you?
Yeah, that's the status of the market. You got lower demand profile, more supply coming at you than you can shake a stick at, and we get the market flirting with that wonderful C word, contango.
Yeah,
If not in the front, at least definitely on the back end of the curve. Carry that market all day long.
yeah. And look, you were on the radio here this morning. That's both members of the Smoking Barrel been on the Dubai Eye Business Breakfast. So well done. I thought it was very good. You were talking about the flotilla, and up you were at 6 o'clock because you're that committed. Let's just show viewers where flat price is. Um, Look, I mean, it's a vastly different screen than what we were seeing a couple of weeks ago. We last recorded on the 7th. I think we were complaining that markets were boring. And it's still pretty boring, but I mean, it's a bit more. Look at structure. This red, this be red. So the whole curve is pretty flat. So we're backwardated. Deck Jan Feb's pretty much there. Probably that's going to get sold off today, I would think. Um, TI below 60, gas oil 636 a ton. Still doing well in the grand scheme of things. $85 a barrel for diesel in Europe. So refining margin still pretty good. Dollar sterling, I mean, it's same as usual, but yeah, bit of a correction in flat price and a whole lot of correction in structure, seeing as where we are with that backwardation that you mentioned. But we have some theories, Edwards, don't we? We have some theories and some data to back it up.
Well, we've always talked about, and we've been talking about it, I think, banging this drum for a while, that for any marketable contango to develop in the crude oil markets, or any weakening to truly happen in the crude oil markets to price out the geopolitical risk, we've got to see a physical manifestation of oil developing somewhere in the market to start backing up the supply chains.
Yeah.
Now, there's been a lot of writing about the quote unquote flotilla armada of crude oil on the water, 1.2 billion barrels, which sounds like a lot of oil. But taking that into the context of oil on the water,
Yeah.
it's about par for the course. It's nothing more extravagant than what's normally there.
Right.
And
And look, yeah, I mean, this is a really good point because we're going to get onto sort of, the facts, or what we have as a facts as Kepler, of course, which are facts, people. What you mentioned there about geopolitical risk, obviously we've seen a ceasefire, Israel, Gaza, we've seen that hold to a degree. There's been a few issues, but there always is going to be. I mean, Russia, Ukraine, obviously there's going to be a meeting between Trump and that, it seems to be coming together. Is that geopolitical risk being priced out? Is that the vast majority of the weakness in flat price? Because there are a few other things going on, but
well,
would you
I
say
think
that
it's
a
not
lot
the
of that
fact that geopolitical risk is being priced out. I just think it's being overwhelmed by people getting more bearish on crude oil markets, because when you start building up spare capacity and storage, it flattens or weakens the ability of a geopolitical event to cause a price spike.
right?
And so I think a lot of people are looking at the forward analytics, the OM report released by the IEA, the EIA, their oil forward view, both show massive stock builds going into year, and then from 2026 onward. So you're seeing anywhere between 2 to 3 million barrels a day of quote unquote stock builds that are going to potentially happen. And so
Yeah.
people are probably trying to get in front of that train. If it's coming down the tracks, who knows? Is that light the IRS um, adjudicator lighting a cigarette, or is it truly a freight train coming to run over the market? Who knows? But nevertheless, until there's still that physical manifestation, you really can't say, are we going to see an oversupply just yet? And despite the fact of oil on the water, to me, the biggest signal is going to be how many ships actually end up sitting in port waiting to discharge.
Right.
Because the
Yeah.
longer they sit in port, the more it gives a signal that, yes, there's not enough room in the inn to accommodate these cargoes.
Okay. I mean, look, let's break it down. So the rhetoric and the dynamic in the market has shifted from being for the vast majority of the year stuck range bound 65s, but in a relatively balanced market, a pretty tight market. Now we're in Q4. Everyone predicts that it's going to be more oil on the water. We've got turnaround seasons. Demand isn't there, and obviously that's put pressure on the curve, and that's why we've sold off.
And, and honestly, a telling sign of all that as well is that you do have a fair amount of unsold cargoes, both in the Middle East and in West Africa. I think
Yeah,
the
but
number I saw was like
like
48 cargoes unsold out of West Africa, which is a fairly high number.
yeah, but like you said, I mean, this morning on the radio is that these guys will find buyers. It might not be the levels they want, but they will find buyers. Okay, just let's okay. On the water, 1.2 billion. Let's put some on my favorite word, some context around it. First thing, our good mate, Mr. Clyde Russell, even though he's Aussie, and I'm going to be in Perth for the Ashes, and he won't be a mate for those 5 days, but that's fine. England, you can forget and all that. But you wrote a really good piece yesterday um, around China, how much China are buying. Here we go. Let me just give you the first paragraph. China's crude oil storage flows slump in September. Okay. China's stockpiling of crude oil has been the market buzz recently, but flows into tanks slid in September as weak imports collided with rising refinery throughput. If anything, this underlines the role of oil prices in China, as September arriving cargoes would have been arranged when prices were surging over the Israel-Iran conflicts in June. Really good, right? And you mentioned something to me before we came on today, the fourth dimension in oil markets, right? Because what we see at the coalface, we see headlines written around Brent future reactions. But when we're talking about physical markets and what Clyde has written there, September cargoes, Israel, Iran, explain how are those two linked and how can you apply it now?
Well, it's just like an astronomer looking at the night sky. The light that we see today in the night sky is billions of years old, if not millions of years old, if not thousands of years old, depending on the distance of the star to the point of observation. When we look at oil markets, it's the exact same concept. The oil we see today is oil that was transacted 6, 8, maybe even 10 weeks ago. And only now is it starting to realize into the physical market space. And so that is what people look at and say, oh my God, what's happening? Um, and as we move forward, so as you got to start thinking of the cycle of any refinery. Right now, you've got refineries who are currently planning not for tomorrow, but they're planning to what crude they're going to run in December and January, and what
Yeah, of
crudes they
course.
want to buy for December and January.
Yeah,
And so, if you don't see those buying signals, i.e., cargoes clearing from different regions, especially when you think of winter, you think we need heavy distillate crudes, which should normally be advantageous for West African grades, which usually have a high distillate yield. And you start seeing African crudes start to back up because there's no buying for those crudes that are loading in November to be ran in December or January. It shows you there might be not enough appetite for that barrel going forward, which could be that physical contango manifestation starting to rear its ugly head.
yeah. Okay, that's one, and I agree. I mean, another mate of mine said yesterday, winter is here. Well, it's not here, right? January, Feb is when people was really start ramping up. So early between mid-November and the end of December is when you really start seeing a distillate market ramp up for power generation. That demand, especially in Europe, China, wherever across the whole northern hemisphere. Let's put some numbers around this flotilla. Okay? Because it needs to be, and look, I will take the flak for this one. I get it. Oil markets have been pretty boring all year. If you are an energy journalist, you're going to really get hold of something that you think is really important and dramatic and put as much hyperbole against it as you possibly can. And that's what people are reading. And arguably, that's why you're on the radio this morning. What is this flotilla? What is this huge glut of oil? But if you put some numbers around it, which fortunately I can because I work at Kepler, here's our, you can see this okay, yeah?
Mhm.
Here is our inventories product that we have. So this is the oil inventories. This covers commodities on the water as well. Okay. So here we have world monthly inventories, including commodities and water for the last 2 years. This is cross everything. Okay. Cross everything. Liquids. Here we are, October 2025, 4.7 billion barrels of commodities on the water right now. This is a 2 year chart. So here we, 2 years ago, we we're at 4.46 billion barrels. Now we're at 4.7 billion barrels. That's 2 years. That is a marked increase, but it's still a shit ton of oil that was on the water then. Let's go back 5 years though, because you mentioned this morning COVID, what happened in COVID. So let's look at the chart there, because this should be a sort of an unprecedented event based on what everyone is reading. Let's go back to all data. Here we go. So we're down here, October 2025, 4.7 billion barrels. COVID, here we were 2019, Bosch, up we went, April 2020, 5.2 billion barrels on the water. And you can see here, where's the next highest point? 4 point, let's go, let's go July 2021 was the last time we were at these levels. But we were at these levels for about 15 months, give or take. So it's not like this hasn't been happening before. Okay, COVID's an aberration. But like you said, if you take the average of all this, and okay, this is like a sort of one-off event, I would say the average over this period of time is probably 4.6 billion, something like that. What do you think?
We would definitely agree. Roughly around 4.6, 4.5, 4.6, easy.
Okay. So this is the global level. So let's look at it in China, because China, second world's biggest consumer of oil, flirts between them and the States. Here is China, and this is all-time high. Okay, we're at an all-time high in July here, 1.25 billion barrels of crude. But if you look at it over the last 6 months, that has been dropping. And here we are now, okay, we're maybe
But
not that
again, if
much.
you look at if you look at it through the lens of the time scale of crude procurement, it would be
Right.
dropping because we are in a situation where, again, you had the 12-day war between Iran and Israel, which ramped up crude prices, what, about $6, $7 a barrel fairly quickly. So that would
Yeah,
curtail a lot of buying interest at that point just because they don't want to buy expensive oil compared to what they were buying before.
right. Exactly. So let's go back to the world monthly inventories since our data goes back, which is January 2017. Now let's split it by tank type. So you've got obviously you've got storage on land, you've got storage, floating storage on a boat, or you've got oil that's on its way from one port to another. So we break it down. So if you look at this flotilla that's on its way, um, that would be under what we class as oil in transit on ships. Or no, hang on. Well, let's look at all of it. So here we are, October 2025. Oil in transit on ships right now is 1.8 billion barrels. Now, let's go back to where it was this time last year. Uh, just over a billion barrels. It stays around that level. I'd say probably you know, okay, there's another 150 million barrels back in the market, perhaps. But if you look at floating storage, this is obviously COVID, nowhere to put the oil. I think in June we hit the record high, 245 million barrels of floating storage. And our methodology is anything longer than we see a vessel idle for more longer than I think 10 days, we class it as floating storage. You look at where it is now, it's okay, 80 million barrels, but it's been okay, 48, 39, that's low. Um, I disagree with the drama that's being put around all these headlines. Yes, there's more oil than there was in July, but it's certainly not a massive shift in the dynamic. Okay, it's flattened down the curve a little bit, but I don't get the drama around it all. if I'm honest.
Well,
And I
I
think
think
our
it's just
data
the
shows
fact
that.
that I think it's just the fact that you've got people trying to get ahead of the freight train. People trying to place their bets, saying that, okay, we think that we will see this overhang. We have high confidence we will see the overhang. You've got all the oil trading shops talking about the overhang that's coming, all the banks talking about the overhang that's coming. So, what do traders do? Start putting their bets on the table about where they think market structure is going to go, and they'd rather be short structure than long structure.
And what do you think on where prices have kind of settled down at these numbers, right? So we went down, let's have a look last week. The high last week was 63.95. The low was $60.14. We've held just above that $60 a barrel mark. We're at $60.75 now. It's come off a little bit. Is that is that a support, $60?
Well, markets like big round numbers, and 60 is a big round number. So is $60, and $60 has been tested already twice in the last week.
Right.
Um, so it didn't hell. It became a buying point, and that tells you that $60 will be a very strong resistance level or support level for the market if the markets get down that low. The
Why do you,
ultimate.
why do you think 60 is, why do you think, and I agree with you, but why do we think 60 is such a significant number?
Right, it's a round number. A lot of algorithms seem to like trading bands that are tied to round numbers.
Right.
Don't know the math around it, but if you look at any time, if you go down any trading chart, you'll see at 60, 70, 80, 90, 100, or even at 50 and 40, bands of strong support or resistance that develop around the big round numbers.
But is it also not significant because that is a number around where shale oil can make money?
Well, it could be if you're unhedged, but I think a lot of the shell producers do put hedges on. So if anything, the dynamic you have of privately held oil production, which is the predominant flow in the United States, versus national oil company production,
Yeah.
which is more akin to the whim of the national sovereignty. The privately owned oil production prices dynamically. So even when they say, oh, yeah, our cost of production is X, well, as soon as you start seeing prices come off, all your support services, which help develop your baseline production costs, also start to come off because if you're a truck driver moving sand into a frac well, you're not going to be sitting out of work because you're trying to price $50,000 for that truckload when now they want 45,000. Well, I might do it for 45,000 just to keep my job, just to keep my food on the table, and not sit around going, well, nobody's paying me 50, so I'm not going to feed my family. Same thing if you're the guy manufacturing pipe. Same thing if you're the guy manufacturing the rig. Rates will accommodate the new price level of crude once it stabilizes because they all want to keep working. Units are not making money if they're just sitting in a warehouse or a laydown yard. They have
Yeah.
to be operating.
Okay. I mean,
So
all right.
it does cause a slowdown in production in the shale area. It does. But then production will kind of flatline, find a new price band, and start operating again.
Yeah, look, I hear you. I mean, look, before we move on to something I want to talk about in sort of wider markets, in equity, etc. You gave a pretty grim price forecast this morning on where you think Brent will end up by the end of the year. Share that with our loving viewers,
All right,
please.
I said a price band, definitely below 55, maybe a price band between 52 and 50.
50 and 52. Okay. Okay. I mean, look, I mean, yeah, okay. I don't know. I don't know. And let's talk about that next week when, because I think if we do get below 60, I think you'll see an OPEC headline. I don't think it'll be like a change in tact or a change in policy or anything like that. I just think there will be one of those Novak says we will adjust if necessary, if or whatever it might be. But I don't know. I said yesterday in my commentary just before we move on that if OPEC do decide to make an emergency cut in supply, would that be a panic reaction by the market to actually sell off because everyone thinks, oh my God, all markets are crap?
I think so. Because remember, everything we're seeing right now is a forecasted number based on the current supply numbers that are being plugged into everybody's models.
Yeah.
And if you adjust one of those variables, the model changes, and what ends up being a 3 million barrel a day supply gut becomes 200,000 barrel a day supply gut.
Okay.
And at that point, and OPEC's doing the exact same thing.
Yeah.
And we've said this once before. OPEC has their analysis, their analysts running their model, and they've got a much more bullish picture than anybody else in the world.
Natch.
So, are they going to continue placing their bets that their model is correct and demand is robust and prices will recover and there will be no massive stock build, or are they going to have that come to Jesus moment where they say, "Oh my God, there is actually a really big supply glut that is building in the market. We need to cut supply."
Well, I mean, look, let's
They have
yeah,
their own self-fulfilling prophecy.
let's see how the week holds out before we get in trouble and talk about that.
But remember, we have
But
the
look,
OPEC meeting in November, first week in November. We have the big OPEC meeting. So
yeah, that's one of the big ones where the press are there and all that kind of stuff.
yeah,
Right.
I think that's actually in person in Vienna. So we'll see how that one shakes out in the wash.
I'm pretty sure my colleague Amina will be there. Right, okay, moving on from us getting into trouble with OPEC. I want to talk about what's happening in the world of equities. I read this article at the weekend, which worried me, and I'm tr been trying to put it in my commentary. It says investors warn on leverage loan risks after First Brand's collapse. Now, for the uninitiated, there was a brand called the First Brands Group was among the largest issuers of loan bought by collateralized loan obligations. They are investment vehicles that buy up small slices of hundreds of individual corporate loans. They have become popular with insurers and other big investors who bet that by spreading their lending across many different companies, they are protected from the pain of defaults in one or two businesses. So this First Brands is
Just what you just said sounds strangely familiar, as if the housing crisis and collateralized loan obligations, where banks were putting subprime
I'd
and
say
loans with um, good quality loans to create a diversified portfolio of loans, which they could then sell to the market.
look, I I have mentioned this, another one, I'm plugging my commentaries today, but I don't care. I've thought about this and I wrote a few things down, and it won't in any way. There are comparisons to make, and I looked at headlines 2 months before the great financial crisis of 2008. What people were writing then, right? And these are some of the headlines. Someone said this was the federal takeover of Fannie Mae and Freddie Mac. It's early September 2008. Money market funds and commercial paper markets are under stress. And it says, and September crisis hits brands by $50 billion. A report showing that the top global brands lost 50 billion in value in just the first weeks of September, 80% of which was in the financial services sector. I don't want to give you the numbers on what happened last week. This was all around, like Russ says. It was this the 2008 financial crisis were prime what was it called? Prime
But
lending.
prime rate mortgage crisis, but it was the collateralization of different levels of debt based on the risk profile, putting it together in a pool of debt, which then went instead of having like an individual bond, which might be rated as a junk bond, but you tie that junk bond with a triple A rated bond. And based on the ratio of exposure inside that portfolio, you ended up with an instrument that was A rated, thus became investment grade.
Right. Yeah, yeah, yeah. Yeah, and because what we went from, and look, I'm not trying to panic. None at all. It's why I'm trying to be cautious. But it's to me, it's not 2008 in scale. I don't think anything like that. But it just seems 2008 in mood, right? I just 2008 deteriorated very quickly, and what happened was that you pulled that thread and all shit went out. So everything went to haywire. People were pulling everything, banks and the Fed had to bail out 700 billion to all these banks and all these kind. Well, that will never happen again because there are rules in place now, right? But when people start to smell smoke, there will be a correction. And that correction, okay, there was a day yesterday when it was good, but things moved very quickly from a healthy correction to a sudden deterioration of everything. Now, these collateralized loan obligations, to me, are just the new, well, the current way, like you just said, of repackaging debt. But instead of doing it through credit default swaps, you're just doing it through amortizing off several companies instead, and then just putting them together and having the same thing. I'm not a cynical old man and much, but there is something that I was reading in the paper at the weekend that was saying the tone was to be extremely cautious, right? And the market has been on an absolute whirlwind since the start of the year. AI is the buzzword. People are now starting to call AI a bubble. I think that's bullshit. I think AI is here to stay. I think it's now part of the fabric of life. I really do. But I just am a little bit concerned that Q4 is going to be a massive correction.
I would say that in my view of everything that's going on, especially what's happened with interest rates from 2008 to today, we went to a massive reduction in interest rates during the financial crisis in order to quote unquote save the economy. And for the most part, between 2008 and 2023, 2024, interest rates were basically zero.
Right.
And you had quantitative easing from the Fed and a lot of other central banks. So you were having liquidity pumped into the global markets, which basically gave a lot of companies the ability to do things because money was free, money was cheap. And so they could leverage up debt rather quickly because interest rates were almost zero. Banks were willing to lend money just to get some money going. I mean, they were charging people for having savings accounts here in Switzerland at one point because interest rates were that negative. So yeah, don't save your money because saving your money is costing you money. But nevertheless, you had a lot of businesses that were developed around a zero interest rate environment.
Yeah.
Now we've had a move where interest rates were moved up rather quickly on the back of the inflation crisis of 2023, 2024. We went from zero to almost 5% interest rates in the US. A lot of other jurisdictions did the exact same thing to try to curtail the inflation. What did that do? That put a lot of companies at stress because as they start to refinance their debt burden becomes bigger than what their cash flows were based
Yeah.
on their zero interest rate environments, thus putting them into a position of financial distress. Now you throw on top of that the reduction in government spending, reduction in government subsidies for a lot of different businesses that are out there. And now you've got a lot of business closures. And we've seen this throughout the whole European and the United States. What's happened to the green agenda and all the green projects that were being produced here in Europe and in the US? They've all been closed
Yeah. I mean,
because
it
the
was
subsidies have been pulled and there's no money to be made in producing biodiesel, solar panels, wind farms, what have you. So you've ended up in this environment where the realities of profit and margin actually start to take hold over um, the fantasy of zero money that was done for the last 20 years.
yeah. I mean,
And I
look,
think
the,
this is
the, the
going
the
to
CEO of
be
Aramco said last week, didn't he, that the energy transition has failed.
well, it was not done. Anything that's done under the back that I need a government subsidy in order to make my business profitable
Yeah.
is not a business.
No, I
You're
agree.
just basically a tax taker at that point.
Yeah.
If you can make your business sustainable on no subsidy, then that's a real business and that should be maintained and you should be able to grow organically from buying and selling your products to whoever you need to sell them to.
Yeah. Well,
So
I mean,
that's, I think, that the issue that we're going to start seeing pop up is a lot of these bad loans are going to turn bad, and there'll be a domino effect, and there will be an impact probably on mid-sized lenders, and we'll start seeing capital constraints come in place.
and okay, before we go, is that why gold's at $4,344 an ounce?
I think that's one of the reasons why gold has had a tremendous rally over the last 6 months.
So that mad forecast we were talking about the other week, and it's 3 weeks ago now. Someone saying that gold could be at $5,000 an ounce by the end of the year. Could it
Yeah,
be this year?
I, I kind of made a joke to one of my friends that we might see $5,000 gold at the end of the month by the way it's been moving.
Okay. Well, okay. I mean, we need a joke. I feel like it's been one of those sort of negative weeks, but look, there's always a lot going on. But I just I don't think there will be like another crisis. I don't, and I just think people need to take note and read. I just think there needs to be more depth in journalism right now for people to actually read about what's going on and why, not just because someone needs to write a story. I fear that that is what's happening in oil markets right now.
Well, I think people are trying to find an excuse to trade because I think we've seen a lot of stories that oil markets and oil trading have not been doing so hot this year. And so people have been struggling in that space of the commodity, but that's the cycle of commodities, to be honest.
Yeah, of course.
Some years oil's hot, some years oil's cold. This year it's kind of cold. So, nevertheless, I think it is a case of looking at the data and understanding the data that's out there and then doing the analytics around the data, not just taking what a headline says about that being gospel.
Okay. All right, mate. Look, always great to catch up. We'll be back at you next week. And
That
yeah,
we will.
good to see you.
Yep. Well, catch us on Spotify, YouTube, and LinkedIn. We look
Yeah.
forward to speaking to you all. And as always, happy trading and stay safe out there.
Ciao.